Let's get across the market open now. Scott Phillips joining us from the Motley Fool. Scott, happy Friday to you. And you got to keep your eye on those press conferences from Donald Trump, don't you? Because once again, he's come out with further detail on his tariffs. He wants to, well, basically, it's reciprocal tariffs. Interesting to see whether Australia is going to be hit at all. It appears at first blanch, of course, that maybe not.
Possibly not, Andrew, and g'day. Look, it was as you say, mate, you wake up in the morning and think, what's he done overnight? A lot of the announcements are actually being made during our morning, so it's kind of then keeping an eye on the news as it breaks. Aluminium and steel tariffs early in the week, overnight, last night or this morning, those reciprocal tariffs. In other words, he's instructed the government to look at the areas where decisions have been made to put tariffs or import impositions on US products going overseas, and to reciprocate. Basically, if you're hitting us, we're going to hit you. That's a very Donald Trump kind of way, let's be honest. But that seems to be the approach announced this morning. I don't know if it impacts us directly, mate, but the bigger concern, as with aluminium and steel, is actually not Australian aluminium or steel industries. They're important, but the far bigger piece is the iron ore that goes to China to make Chinese steel that then otherwise is imported to the US, and probably the same with these reciprocal tariffs. I'm thinking about where we are the supplier, not of the finished product, but of the raw material, as well as those finished products themselves, of course. So, yeah, look, this is a trade war is probably overstated, but is a tit for tat, battle, if you like. Where this ends up, it's hard to tell. I'm not sure there's much left to do in terms of the economic tariffs. The thing is, of course, Donald Trump is using them not just for economic purposes, but for political and literally base political purposes, as well as just, advancing US interests more broadly. So I dare say this won't be the last time we talk about them. At the moment, I don't think there's a really significant impact directly of the announcement overnight or this morning, but the flow-on effect, the second and third order impact of what does it mean to the countries we supply to, what does it mean for their own economic circumstances, and how does that impact, for example, their demand for other Australian products, not even raw materials, just our exports in general. So everything is up in the air. This is a game of proverbial 52 card pickup. We're going to have to try and work out what happens next and where the chips lie. Multinationalism rather than bilateralism is probably part of the solution. The US may or may not find itself increasingly isolated. We'll be looking to move trade deals to outside the US, to countries that want to do business. How that all nets out, again, really, really hard to see. The one benefit we've got is Australia actually has a trade deficit with the US. We're one of the few countries the US has a trade surplus with from their perspective. So what it basically means is we're not as impacted by these changes in the US. I'll call it isolationism, call it protectionism, call it what you want. We're not as impacted directly as other countries, but it is that flow on second and third order impact we need to be mindful of.
Yeah, you mentioned those miners obviously in focus. Actually, interesting news today too, Scott, we'll keep our eye on. There's a Category 5 cyclone that's due to hit Port Hedland, so we'll see whether that impacts particularly those exports. So that's one to keep an eye on. Just quickly also in that mining space, the gold miners, what are you seeing there at the moment, given that bullion price pretty close to 3,000? Looks as though it's closing in on that.
Yeah. It's extraordinary, man. And you know what's really fascinating is you've got different parts of the investment markets making really different bets. Very, very rare you have the ASX with a record on gold price getting up towards $3,000 an ounce. That combination, you've kind of got bets being made about, do we go with it in equities? Do we look for the safety of gold in an inflationary environment or uncertain environment? Potentially more money printing coming, which is what the market's worried about. Bond yields have been increasing over the medium term as well. So you've kind of got really, really interesting, not necessarily opposite bets, but very different directional bets being made by financial markets at the moment. And there are some of those people say, hey, this looks like the place to be. Now, I will say, as I generally do, I don't love resources when they get meaningfully above the cost of production, because it just means more can come on stream. And that is the likely solution, right? If you can sell it for $3,000 an ounce, go and dig some more up and sell it. That's probably the supply response that we should expect if the price stays high. So I tend to look at resources counter-cyclically. I know it's not what the cool kids do, but if the price is high, the risk is very much, I would say, larger than the return. We don't know for sure, but it's clearly not in the favor of the investor buying today. Doesn't mean it can't go higher. It just means probabilistically you're not likely to do as well. When the price is low, close to the marginal cost of production, you've got plenty of opportunity for upside from there. Again, not guaranteed, but the risk reward is in your favor. So I think we just need to be a little bit careful, even if, remember, this is lithium all over. We tried lithium for age over the last 2 or 3 years. You've got to see the price of the lithium producers at the moment. I think Liontown's, 60 odd cents. It was $3 not that long ago. When you see a supply response, you do see the commodity price fall. That is literally economics 101. What we should expect And so just be a little bit careful with gold at these levels. I don't have a prediction for you. I don't have a forecast. I do have a probabilistic approach, which says when the price is that much higher than the cost of production, it just incentivizes more supply, and that normally puts some downward pressure on the price.
Now, Scott, of course, we are well and truly into earnings season, a big one.
Yep.
Biggest in fact this week is CBA. What did you make of that result?
Oh man, massive. Hey, $5.14 billion, if you don't mind. On track for a $10.3 billion year if they can repeat the same dose. I'm going to release some people, mate. CBA at 28, 29 times earnings is incredibly difficult to justify when cash profit growth was 2%. There is no maths in the investment world that makes that make sense. You can buy it for income. You can buy it because it's a blue chip. You can buy it because it feels safe. You can buy it for any one of a number of reasons. I don't think you can buy it justifiably on the current earnings and the current price, unless you have some sort of heroic growth assumptions. A business growing at 2%, you might pay 14 times earnings, 15 times if you're really lucky. A really high quality business, maybe a stretch to 17 or 18 if you're feeling really bullish. 28, 29 times, I can't make it make sense. It does not make sense at all. Does it mean it'll fall again like gold? No. If everyone still loves CBA and they love it beyond rational pricing, then it can stay as high, go higher. Frankly, there's no reason it can't. There's the market in the short term is a voting machine, as Ben Graham famously said. The voting will determine it. Over the long term, I just don't know how you justify. You can't justify buying at today's price on any basic economic fundamentals or investment fundamentals. You have to simply believe people will always pay a price for CBA that is disconnected from its fundamentals. And if that is true, then you'll be okay. If it's not true, if that stops being the case at some point, then you do run the risk of some really ordinary returns. It is the best of the big four banks. We know that. Remains to be seen what the other big banks deliver. Normally when CBA's profit is pretty flat, the other banks are down. So we'll see whether that remains true. Interestingly enough, too, they got faster growth in business than in personal loans. And I think there's something to that. Westpac have been out there shaking the tin, trying to get some more business customers through the door, offering free legal services and other things as part of the package. I suspect that's where the next war is when it comes to lending, because housing's largely tapped out. Again, who knows what happens? Rates drop, maybe things change. Here's the other thing, by the way. It didn't happen. Normally when rates go up, margins are supposed to expand. They didn't. When rates go down, margins are supposed to contract or at least have contractionary pressure put on them. I don't know if that'll be the case this time either. They didn't go up last time in the hiking cycle. Maybe they don't go down as rates contract. But again, think about risk and reward. The risk is on the downside. Why? Because you can't pay people much less for deposits than you're already paying. A lot of the time it's zero. As the loan rates come down, you normally have that margin compression. Again, it may not happen this time around. But again, business growing at 2% with some margin compression possible. You can't pay 29 times earnings, 28 times earnings for that sort of business. So a great result in terms of total dollars, not particularly flash in terms of growth, and the valuation just way out of kilter.
And what should keep going up?
That's totally right.
Yeah.
And it has. I mean, it's up 40% over the last 12 months. And you think, how does a business growing at 2% get a 40% share price bump? There is, again, so someone who's, I'm not a value guy. I'm trying to mix on value and growth. I don't really have a particular school I sit on. But there is no growth and there is no value. I don't know on what basis you buy.
Well, it's just that default setting, isn't it?
Right.
Scott, just very briefly, a couple of consumer-facing stocks. What are you seeing there? We've had results from Treasury Wine Estate, also Temple & Webster.
Treasury, fascinating, mate. Penfolds continues. I own shares, sorry. Penfolds is a great business, huge margins, great pricing power, really, really solid business there. That is absolutely the jewel in the crown. There's hardly much of other of the crown left, honestly. They've tried to sell off the mass prestige, they called it. No one wants to buy it. It's very, very, very hard to make a buck unless you're selling super premium wines. And we've known that for years. Treasury tried to make it work. They finally realized they couldn't. But by the time they've done that, there was no buyers left effectively. They've taken some of the brands off the market. Maybe they sell some of what's left. Maybe they close down some of what's left. They've got to cover the lost profit if they do it. But the margins on that stuff are just tiny compared to some really healthy Penfolds ones. Again, the price, the company share price suggests there is some requirement for delivery of profit from that other business, but it's really ordinary. If you can find a way to exit most of that without losing too much profit, you do it tomorrow. That's got to be the question. It is. The Penfolds business, again, is great. They will probably, again, I'm a shareholder because I think the Chinese demand will continue to grow. I think Penfolds' pricing power continues to grow. They seem to not have found the upper bound for what they can charge for some of those red wines in particular. As long as that remains good, the Penfolds brand should grow. It should make the other brands less impactful as a share of the total, which is kind of what you want. Whether it's enough to justify the current price, that's the question for investors. I think it probably is, but we'll have to wait and see whether they can get out of this business without costing them too much money.